since late October, a lot of the things that have corrected in risk markets have been the things that did really well this year. So like the AI stocks have sold off, the nuclear names have sold off, the quantum names. So these are, they've been very popular with hedge funds and retail investors. And they've had what you'd say is their price has outperformed the expectations around earnings growth. So basically the risk premia has fallen or their multiples have gone up. So that's what's derated. And if someone asks me why things have derated, I think it actually is just possibly a couple of things. One is the Fed isn't really dovish. I mean, the Fed, people haven't decided, and the Fed still hasn't decided if we're in a disinflation cycle.
Yeah.
And if we are, they should be cutting. But like, as you know, every Fed meeting is a coin toss. I mean, look at in the last week, the odds of a December cut had dropped. They went from 70%, dropped to like 30, and are back to 67. I mean, that's for Fed cutting in December, have moved that much, show you that there is so much uncertainty around monetary policy. And as you just kind of described, the current White House and the president is very divisive because there are those who didn't vote for him. And for whatever reason, this White House has really become a lightning rod for divisive and dissent. I mean, there was even last week some military members suggesting they should disobey orders from their commanders. I mean, that's very politically divided. And the third is there probably was leverage being built up in the system. I mean, in equities and in crypto. And so we're just seeing a leverage reset. I don't know if that really helps, but I mean, I'd say that those are contributing to like why crypto probably isn't performing as well as we think, because you're exactly right. There's so much building being done. And actually we know that there is so much being built by Wall Street wanting to actually embrace and build on the blockchain. So, does that mean crypto is broken, or are we in a period of time where the fundamentals are doing better than the equities? I mean, I think that's where we are right now. Because number one, the Fed is the most important entity in the world. I mean, as you know, they say bull markets don't die of old age. They get ended by the Fed, right? So maybe the Fed pretty much drives based what happens to risk assets and then ultimately to the business cycle. And this current Fed is not operating with the clarity that most investors want. And part of it has to do with there's, of course, been a very visible dispute between the White House and monetary policy, and even questions of Fed independence. And as a consequence, Powell, I think, has done a really good job of navigating this. But keep in mind, he is the Fed chair, but then he has to corral all the other voting members, of the committee, the FOMC. And each of these voting members represents thousands of people that work for them. So the Fed is, 30,000, I think maybe 20 or 30,000 total employees. And as you know, they're concerned about their existential independence. So I think every voting member feels that pressure from everybody that works for them, that if they cut rates, they're just bowing to the White House. And whether or not they claim to be independent, they can't escape that pressure. And I think that comes through in every comment. Like what you just cited, someone from Boston, the Boston Fed, saying they don't see the need for a cut. Objectively, that's dead wrong, because the bond market, the Fed funds implied futures, or even 1 year forward inflation, say there isn't really an inflation problem, which means if inflation is falling and Fed funds stay here, real interest rates are getting tighter. So the Fed is unwittingly causing monetary policy to tighten because as interest rate expectations fall, and the UMich survey showed a drop on Friday, they're actually unleashing more tightening into the economy. So I think it is a real problem. But of course, the Fed can, of course, correct really quickly. Mm-hmm. But over the weekend, people read the paper, like you said, and price makes people drive sentiment. So not only do people panic over the weekend, but as you know, outside the US, everyone looks at this and if they're getting concerned about monetary policy and they own a lot of crypto, they're just going to sell their crypto.
So what do you think? Obviously, rewind the clock 2-3 months ago, I feel like the inflows from ETFs, from DATs, drove the crypto market in addition to macro. To what extent does the sort of unraveling of DATs, so to speak, how much is that playing a part in this story?
Yeah, DATs have been part of the 2025 narrative. And I think that there has been, as the number of DATs have grown, and we've talked about this, not all DATs are created equal, because a proper DAT, a proper digital asset treasury, really needs to serve as a bridge, right? Because it's a bridge between the institutional or public equity world and the crypto world. And a DAT there shouldn't just represent passive exposure to crypto. It should really serve a function. And so MicroStrategy, as you know, is really the blue chip and the flagship and the first crypto treasury. But what they've done is they've accumulated a lot of Bitcoin, and then they've essentially turned it into a type of financial institution where they're productizing their Bitcoin holdings and offering yield products, and in a way that takes advantage of the characteristics of Bitcoin, which is the volatility of Bitcoin, and it's also stable store of value, right? I mean, basically Bitcoin over the long run is going to go up in value. So they have an asset that they know is appreciating. And then, as you know, a lot of other crypto treasuries followed suit, a lot of Bitcoin treasuries, but many of them didn't raise capital in a way that created accretion for their shareholders, or they had expense structures that were expensive and less attractive than an ETF, or they didn't really have a clearly defined function. So I think that this is the shakeout that happens, but that's kind of capitalism. I mean, since 1970, 44,000 stocks have gone public. Okay. Now, we know there aren't 44,000 companies in the stock market today. The reason being, and we've looked at this, 90% of stocks fall 90% once they go public. And of those, only half of them ever recover. So basically, most companies that ever go public are failed equities. That's the reality. That, like, when someone says like SPACs came and went and only 5% survived, that's pretty true of IPOs. That's pretty true of spinoffs. That's basically pretty much true of any business. We know that in, like, for instance, in restaurants, 95% of restaurants fail after 3 years. So does that mean every restaurant is a bad business? No, it just shows you the businesses that survive must be really good businesses. And so in my opinion, what's happening with DATs is going to prove that the ones that survive and prevail or raise capital or are big are probably far better businesses than people realize, because they survived capitalism. You can't, just think about the premise. Someone says, oh, I'm just going to create a crypto DAT and my stock's going to go to the moon. I mean, it's kind of absurd, right? Because an equity investor is not just buying a ticker. they have analysts. These guys talk to the companies. They talk to the chairman. They understand the strategy, and then they want to know if their stock price is aligned with the vision. So I wouldn't expect most DATs to survive.
I guess the time horizon's different than in US, well, in IPOs specifically, or in restaurants. I like that example. You don't see 90%, 95% of restaurants, for instance, fail within a 6-month period of time, or however long we'll see this shakeout last. But I get the sense that it'll be shorter, and that impact, I guess, hurts. Things like the DAT implosion that might be on the horizon. Following so shortly, the DAT Cambrian explosion might turn off new flows or people from the market.
I mean, Frank, that's a really good question. I mean, I think that there's still unwritten chapters to the DATs, right? Because there's all these DATs trading below NAV. And if they have a staking business, then in theory, they probably can survive, because if they've raised money and they have 3% yield, or if it's Solana, 7%, in theory, it's a viable entity. As long as they didn't take on debt, they will still have this problem of their stock price being stuck in the mud. And there is several ways to solve that in the future. One is the company itself is now essentially a closed-end fund trading at a discount, right? So what can they do? One, they can actually become an investment company and turn into an ETF, and then they go back to par. They can begin to, if they're a staking entity, they could pay out their staking yield, and they'd be a yield-bearing instrument. They can sell their crypto holdings, and some have done that, and distribute the cash. But they have to distribute the cash. If they're going to sell their crypto holdings and just sell it cash, then they're just misallocating capital. I mean, there's a signal, I think, if something's trading at a big discount to NAV, because it shows you the market doesn't believe that management team can allocate capital. So then the last option, of course, is that they should be consolidated away. But that takes time, because as you said, it's only been a few months. Most people have unrealistic expectations. They always say the problem with M&A isn't the buyer's willingness, it's the seller's price. So, if someone's trading at 0.7 MNAV and they want to get NAV, that's a 50% premium to the buyer. The buyer, there's a pretty high bar for someone to be willing to pay NAV for something at 0.7 times NAV. So it's going to be, it's a process there. But should that really hurt crypto? I mean, at the end of the day, there is a lot of reflexivity in crypto, but the DATs aren't really what's creating the building, and that's not really what's driving, for instance, what's happening on blockchains and stable coins and real world assets. That none of that really has to do with DATs, unless the DAT itself is funding specific projects. And on the Bitcoin DATs, I think that they had a theory that everybody would own a little bit of Bitcoin on their balance sheet. And I don't think that's wrong. But I think the DATs that were small and subscale, saying that because they own Bitcoin on the balance sheet, they should be more valuable than another company that owns Bitcoin on the balance sheet. That's probably where the market is just repricing everything. And they might even be pricing whatever that DAT owns as an operating business as a liability. And that's why they're trading below NAV.